This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
All right, let's go through the very last question in section B from the December 2014 paper F9 exam. So let's look at the requirements. Part A for 9 marks. Calculate the market value weighted average cost of capital and the book value weighted average cost of capital of TNAP, and comment briefly on any difference between the two values. So a brief comment, so most of the marks will be for the calculations, but certainly there'll be a couple of marks for commenting. And part B, all writing here, but discuss the factors to be considered by TNAP in choosing to raise funds via a rights issue. Now, I'll do them in order, but I've said several times, if you've been reading the others, you need to be aiming for half marks on every question. If you can get 7.5 marks on question 5, you're passing it. There's 6 marks there writing about a rights issue, and you really should be able, it's hard to get full 6, but you should be able to get most of those marks. It's very, very standard. Whether part A was easy or hard, you don't need to have done part A to get the 6 marks from part B. And if you can get 6 marks for part B, or to be passing it, you don't need to actually get very much right from part A to just get the extra 1.5 marks. From then on, any extra marks are, in a sense, bonus marks. Anyway, I'll do it in order. Calculate basically the weighted average cost of capital. I'll explain what he means by market value and book value as we go through it. But the normal way, the way we always calculate weighted average, unless we're told differently, is we work out cost of equity, cost of debt. We then weight them by the total market values of equity and debt. And so let's do it. First of all, what's the cost of equity? So look at what we're told. We're given an extract from the statement of financial position there. The ordinary shares, they have a nominal value of 50 cents per share. They're currently trading on the stock market at an ex-div basis of 5.85 with an equity beta of 1.15. Now remember, when you were calculating the cost of equity, there are 2 ways he can ask you to do it. Either he gives you betas, as we're given here, and we can use capital asset pricing model. Or if you're not given beta, you'll be given information about current dividend and growth rates, and you can use the dividend valuation formula. However, here we are given the beta, and we're given the equity beta. It's the beta of equity that determines the cost of equity. Sorry, going on here, it's not relevant for this particular question, but trying to teach at the same time. If we were given an asset beta, then we'd have to use the formula to work out an equity beta. But here we're given an equity beta. So it's the risk-free rate. It says in the last sentence, or the last paragraph, the risk-free return is 4%. Plus beta, we just saw beta is 1.15 times the difference between the market return and the risk-free, which here they've told us the risk premium is 6%. So if the premium is 6%, it's just 1.15 times 6, which is 4% plus 6.9%. It's 10.9. So there's cost of equity. Before we start looking at weighted average, we need the cost of debt. So again, what information are we given? The debt from the statement of financial position is the loan notes. They have a nominal value of 100. They're currently trading on the stock market on an ex-interest basis of 103.5 per loan note. The interest is 6% a year before tax, and they'll be redeemed in 6 years' time at a 6% premium to the nominal value. Well, very, very standard. Remember, if it's redeemable debt, as it usually is, to calculate the cost of debt, we have to set up the flows and calculate the internal rate of return. And so let's set up the schedule on $100 nominal. There's a market value of at time zero of 103.50. There's then interest each year for how many years is it? I had it a minute ago, I've lost it. They've been redeemed in 6 years' time, so there's interest for 6 years. It's a 6% interest, so 6% on nominal value, which is $6 a year. However, with tax in the last line of the question at 25%, the after-tax interest, company gets tax relief on the interest. The after-tax interest, 1 minus T, or it'll be 75%. So a net of tax of $4.50 a year. In 6 years' time, they're redeemed. And the redemption, it's a 6% premium to the nominal value. So for $100 nominal, the repayment, 100 plus 6%, will be 106. And remember, the redemption isn't tax allowable. Having set up the flows, it's then the internal rate of return in the normal way. 2 guesses and approximate. Any 2 guesses will do, but be sensible. I don't think there's much point in guessing at 20% or something. As a very rough guide as to where to start, it's a very rough guide. I say, oh well, $4.50 a year on 103.50. What percent does that come to? It comes to 4.3%. The answer is not going to be 4.3 because of the redemption, but it's somewhere in that sort of size. I'll make my first guess at 5%. So let's guess at 5% and see what we get, and then I'll make a second guess. So at 5%, the present value of 103.50 is 103.50. We've then a 6-year annuity. And so the annuity factor 6 years at 5% is 5.076. Before I multiply up, while I've got my tables, the redemption, the ordinary discount factor, 6 years at 5% is 0.746. So the annuity 450 times 5.076 is 22.84. The redemption 106 times 0.746 is 79.08, which gives me a net present value of minus 1.58. Because it's negative, the internal rate of return must be lower than 5%. Were it positive, it would be higher. Well, since it's going to be lower than 5, make your second guess at less than 5%. 3%, 4%, doesn't matter. I'll guess at 4%. Let's see what we get. 103.50, again, it's 103.50. The discount factors, the annuity factor for 6 years at 4% is 5.242. The ordinary factor for 6 years at 4% is 0.790. So the interest flows, it's $4.50 times 5.242, 23.59. 106 times 0.790 for the redemption, 83.74. And so this time an NPV $3.83 positive. The internal rate of return must be somewhere between the two. Now, how you do it is, I don't know how you've been learning it. Some people learn a formula. I hate learning a formula. It's the middle of an exam, I always forget it. But if you've learned a formula, by all means use it. Some people use little triangles, which I find most bizarre. But if you want to, do. I'll do it the way I do in the lectures, which I think once you've got the idea, there's nothing to learn, it becomes automatic. But at 4%, the NPV was 3.83. At 5%, the NPV was 1.58 negative. And so over a change of 1% interest, the NPV fell from +3 to -1. It falls by 1, 4, I think 5.41. So we get all upset about brackets. If you want to put brackets, put brackets. It doesn't really matter. But having looked at the difference, then we can write the answer straight down. Because the cost of debt... Sorry, I want to remove those brackets. Really don't know to bother. The cost of debt is the internal rate of return. Here, from our guesses, we knew since 4% was positive, it's more than 4%. How much more than 4%? Well, at 4%, the NPV is 3.83. We need it to drop from 3.83 to 0. So we need to fall by 3.83. We know that 5.41 is a change of 1%. So 3.83, well, is this fraction of 1%, which comes to 4% plus 0.71. It's 4.71%. Now, the risk of repeating, I say again, use whichever way you're used to. I mean, although there are several ways of getting the IRR on those figures, there's only one answer at 4.71. If you haven't learnt it, and the way I just did it, if I went too fast, then go back to my lectures, where I do spend time going through it slowly. Also remember that any answer is only actually approximate because it's assuming a linear relationship and there isn't one. The reason I mention it is that it doesn't matter what guesses you've chosen. I mean, having guessed at 5, it should be clear the IRR is less than 5, so the second guess should be less than 5. You could have done it at 3%. I'm not going to. But if you'd made a second guess at 3%, you would have ended up with a slightly different internal rate of return. In general terms, it could easily be up to 1% different. In the exam, you won't lose marks. The markers know this, that we can't, although I'll leave it at 4.71, you can't say it's precisely 4.71. It is only approximate. So if you have made different guesses, 6% and 3%, for example, if you get a lot different than 4.71, you've made a mistake. But assuming it's somewhere around that, you've probably got it right. You'd still get full marks. But, as always, do show your workings. You must make it clear you know what you're doing. You know, even there, I could have made a silly mistake. Arithmetic mistake. That's half a mark, that's all. Because it's clear from my workings that I do know what I'm trying to do. and therefore any error is just a silly mistake. However, where are we? We've worked out the cost of equity. Save me what going up and down the screen. Cost of equity, I think I better just check. 10.9. Yep, 10.9. We've just worked out a cost of debt, and I'll use my figure despite what I said, 4.71%. It's now a question of weighted average. Well, he wants you to do it two ways. He says, first of all, calculate the market value weighted average. And this is the way we normally do it. For equity and debt, we take the individual costs that we've calculated. We work out a weighted average. We weight by the total market values of each. Well, what's the total market value? First of all, of the equity. From the statement of financial position, the nominal value in total is 200. I'll work in millions. However, there were 50-cent shares. So if it's $200, but they're 50% shares, there must be 400 million shares. And the market value per share is $5.85. So the total market value of the equity is 2340. As far as debt's concerned, from the statement, there's a nominal value of the loan notes of 200. The market value, second paragraph beneath the statement, it's 103.5 for every 100. And so the market value is 207. Given a total market value of 2547. And so the weighted average equity is 2340 out of 2547 times 10.9%. Debt 207 over 25407, that proportion of 4.71%. Giving me a weighted average cost of capital 2340 divided by 2547 times 10.9 is 10.01. 207 divided by 2547 times 4.71 is 0.38, 10.40%. So there's the market value weighted average. I said earlier, if you'd had different guesses for your cost of debt, you'd have got a bit different than 4.671. However, because debt's such a small proportion, almost certainly the weighted average would have been the same, but you don't lose marks for having used different guesses. Well, that's market value, and usually that's the only way usually we do it. In other questions, if they simply say calculate the weighted average, that would be it. It's automatically market value. Here, he specifically, though, asks you what the book value weighted average is. Now, it's very rare, and don't do this ever unless you are specifically asked for it. But all it means is we will take a weighted average just as before, but instead of using the market values of equity and debt, we'll use the values from the statement of financial position. So equity, the cost we calculated was 10.9%. The debt was 4.71. Those don't change. All that changes is the weighting. And what is the total book value of the equity? Well, it's the share capital and reserves. It's 850, the total book value. The debt, the book value of the loan notes, is 200, a total of 1,050. And I better just mention one thing, but this occurred in one of the questions also in the in section A. The book value of equity is, as we got there, the share capital plus reserves. According to the statement of financial position, shareholders are worth in total 850. However, when we're looking at market values, we don't add on reserves. Effectively, they're included. The most obvious reason why the market value of equity is higher than the nominal value is because the shares are worth more, because there are retained earnings, there are reserves. However, the weighted average, same logic as always. This time, equity is 850 out of a total of 1,050. That proportion of 10.9. Debt, 200 out of 1,050. And so the weighted average on this basis, 850 divided by 1,050 times 10.9, I get 8.82. 200 divided by 1,050 times 4.71, I get 0.90, I get 9.72%. So as far as the arithmetic is concerned, that's it. That should be pretty quick, actually. The only bit that takes time is calculating the cost of debt. But you're bound to have internal rate of return somewhere in the exam. You're bound to. Whether, like here, it's calculating cost of debt, or in other cases, you're asked to do it as part of project appraisal. So it's bound to be there somewhere. And once you've got the hang of it, well, it's always the same. You've got to make sure that's quick marks in the exam, that you're not taking too long. I do know, though, Part A, I said earlier, that although most of those 9 marks will be for the arithmetic, and I've said enough, there will be a mark or two, or probably 2 marks, for commenting briefly on any difference between the two values. Well, of course, they will be different because they've been valued different, weighted different. But there are really 2 comments that should be made. One is that market value weighted is the more sensible. That's what we normally do, because market values are showing what you might call the true amount of borrowing from equity, borrowing from debt. The book values, of course, they certainly aren't showing the true values. Secondly, the 2 bits to it, the equity, the loan notes, it's equity where there's the biggest problem, is that I'm not saying it's a rule, but usually, of course, you'll expect the market value of equity to be higher than the book value. It doesn't have to be, but you normally would expect it, and it is here, obviously. Book value only 850, market value a lot higher at 2,340. Whereas debt, although market value, of course, can and here is different than book value, they're likely to be reasonably close. You'd never expect them to be massively different. And so debt, it's not much difference. That's not much of a problem. But because equity, the market value is always likely to be a fair bit more than the market value. It does mean, than the book value, I'm sorry, it does mean when you're basing it on market values, there's much bigger weighting given to equity. And of course, equity, you'd always find will be more expensive, the cost of equity, than the cost of debt. And so, using market values, it almost inevitably will give a higher weighted average, or book values will give a lower weighted average. So that's the point you need to make. I mean, if I said that too fast, read his answer. But we should use market values. If we used book values, you will almost certainly underestimate, you'll get a lower weighted average. And say why it's going to be lower. Again, it's because book values of equity are likely to be substantially lower than market value. You'll be giving less weighting to the cost of equity. Well, I think I've said enough. All right, that's part A. Finally, part B. Discuss the factors to be considered by TINAP in choosing to raise funds by a rights issue. Now, I said before, this really is independent. So, although you should be able to sort out part A reasonably quickly, if you've got stuck or we're taking too long, you don't need to have got anything from part A to be able to do part B. The factors to be considered with a rights issue. Well, I really can't add anything to the examiner's own answer, which is extremely good. You know, I've said several times, he does always write more than he expects, or usually, because they're nice to learn from. But here he has kept it very brief and I think very clear, so I'm not going to just write out his answer. But you all know what a rights issue is. It's shares, you offer shares to existing shareholders. And so the sorts of things you'll consider if you decide, when you're deciding whether or not to use a rights issue. The issue price. It's a big problem trying to decide what price will you issue the new shares at. You know, although you don't need to refer here to part A, shares in this company at the moment have a market value of 585. Well, on the one hand, the company will want to charge as much as they can when they issue new shares. But on the other hand, they've got to give people an incentive to buy them. And so they'll generally issue at a price lower than the current market value. But it does something they have to consider. What price will they issue at? Are they going to issue at $2, $3, $4? There's no easy answer. It's something he's considering, which is what he was after. The relative cost. Well, I mean, there is the cost of actually doing the issuing, the raising. And he's said, and again, it's very standard, and it's in the notes and it's in the lectures on the website. But you know, you can finance simply using retained earnings, reduce the current dividend if there's enough there. And in a sense, that's free money. There are no costs involved in raising it. Having a rights issue, there will be costs involved, even if it's just sending out letters to the shareholders. But it will be cheaper than a public issue, where there are many more formalities involved, which cost money. So anyway, it's another consideration. What's the cost of actually doing it? Ownership and control, an important one. You're offering it to existing shareholders. And so shareholders continue to hold the same percentage. There's no loss of control as there is with a public issue. There's lots of new shareholders coming in. How significant a factor that is depends on whether you have currently shareholders owning high proportions, having control. Finally, the effect on gearing and risk. This isn't specifically just to do with rights issues, but certainly if you're raising money by any issue of shares, then you're reducing the gearing and therefore the gearing risk. On the other hand, if you chose to raise the money by issuing more debt, or here, loan notes, then it would increase the gearing. And again, it's not up to you to say which is good, which is bad, but it's something that needs considering. when they're deciding how to actually raise the funds. Right. Well, I didn't write much, but I told you why. Read his answer, learn from it. Okay.